The market share of precious metals and precious metals related assets relative to other asset classes in the United States is less than 0.5%, which is to say less than 0.5% of all the savings and investment assets in the United States are comprised of gold and silver. Remember that 40% of most institutional accounts are held in bonds, which means that 40% of most people's portfolios, most institutional portfolios, are losing money now. As the biggest institutions in the world begin to disintermediate the bonds, that has to go somewhere. And some of it will go to gold and silver. As we've said before, it is estimated that the 3-decade mean market share of precious metals and precious metals related securities is between 1.5% and 2%. If some of that disintermediation from the bond market goes into gold and silver, which I suspect it will, if gold and silver merely revert to mean in terms of the market share, demand for precious metals and precious metals equities somewhere between triples and quadruples. And that's what I think is going to happen. When people talk about the silver squeeze, they're talking about a whole crowd of young investors who've done actually a wonderful job educating themselves as to why they should own precious metals. But the real squeeze happens when the biggest institutions in the world add precious metals back to their balance sheets. They were all there in the 70s. They all know the way, although the people who put that precious metals and probably now put that precious metals in those portfolios have probably deceased. But I'm highly confident that over the next 3 or 4 years, you will see the largest institutional investors in the world reallocate to precious metals, both gold and silver. And that's where the squeeze will come in. The squeeze will obviously be interesting in the futures market, where there is small enough physical coverage relative to the daily trading volumes that it secures. But I suspect that you'll see shortages other places. I believe ultimately, Dunnigan, markets work. And the way you solve a shortage is you raise the price, something that I, as a gold and silver holder, sort of look forward to. My personal investment technique is to try to establish a value in my mind for any investment that I go into. I worry about the value before I worry about the price. Let's say that I decide that the net present value of XYZ gold mines is $1 billion. I define net present value as the discounted free cash flow from reserves and resources over the life of mine. And let's say that I think the company's worth $1 billion. And let's just say for fun, it has 1 billion shares out. So it's selling for $1 a share. Pardon me, I think it's worth $1 a share. But it's only selling for 50 cents a share, which is to say I think it's worth twice what it's selling for. Well, that's pretty attractive to me, so I buy some stock. Let's say, just for fun, that the gold price goes up. If the gold price goes up, then the net present value of the free cash flows increases. And so I need to recalculate. If the gold price goes from $1,800 to $2,000, that is, the gold price goes up by 10%, likely the free cash flows go up by 20 or 25%, which means the net present value goes up by 20 or 25%. So rather than being worth $1 billion, it's worth $1.25 billion. And I need to recalculate like this all the way through with regards to a company that's generating free cash flow that can be valued in this fashion.